Welcome back as we continue discussing the character of recognized gains and losses. Recall that the type of asset that we sell will drive the character of the gain or loss during a property transaction. In particular, there are three key types of assets. First, an ordinary asset is one that is used in a trade or business that's held for 1 year or less, and assets such as inventory and accounts receivable are always ordinary assets. Second, we have capital assets, which are assets held for investment, production of income, or personal use. Usually we think of stocks, bonds, or personal assets such as a house or a vehicle. In the previous set of videos, we focused on ordinary assets and capital assets, which produce respectively ordinary income or losses and capital gains and losses. Recall that ordinary income, and in fact short-term capital gains, are subject to the higher ordinary income tax rates, while long-term capital gains are subject to the lower preferential tax rates. Now, the third type of asset that we haven't talked about is known as a Section 1231 asset. In this video, I'll introduce Section 1231 assets and show how they're incorporated in the netting procedure that we covered in the last video. So first, Section 1231 assets are neither ordinary assets nor capital assets. So they're not inventory, accounts receivable, or notes receivable, and not copyrights, compositions, U.S. government publications, or personal use assets. What Section 1231 refers to is depreciable personalty and realty as well as land used in a trade or business or for the production of income. A key element to be a Section 1231 asset is that the asset must be held for more than 1 year. That is, this is, by definition, a long-term asset. There is no such thing as a short-term 1231 asset. This long-term holding period is absolutely critical to be met in order to be designated as a Section 1231 asset. So some examples here could be land used for the production of income, held for more than a year, or an office building used in a trade or business held for more than a year, or a business machine held for more than a year. So why are these Section 1231 assets and not capital assets? Well, the key here is that Section 1231 assets receive extremely favorable tax treatment. If you sell a Section 1231 asset at a gain, it gets the long-term capital gain treatment. So the gains are taxed at preferential rates. However, if you sell a Section 1231 asset at a loss, that loss is an ordinary loss, fully deductible, and can be used to offset ordinary income. So the Section 1231 loss is not subject to that $3,000 limitation that applies to capital losses. So in all, Section 1231 gets the best of both worlds. If there's a gain, it's lightly taxed. And if there's a loss, it is fully deductible against ordinary income. So not bad. Of course, if the tax rules provide some major benefits, rest assured that some taxpayers will try to exploit these rules even further. One easy scheme here would be, to the extent you have them, is to sell the Section 1231 assets where you have losses in 1 year to get the ordinary loss deduction. And then, in the next year, sell the Section 1231 assets where you have gains so that you can get preferential tax rates. So here you play the game where you win in both years because you group your loss assets together to maximize your deduction, and then group your gain assets together in another year to minimize your tax rates. Well, the IRS wants to prevent these kinds of timing games. So what they'll do is, to the extent you sold Section 1231 assets at a gain this year, the taxpayer will have to look back to the prior 5 years to check if any Section 1231 assets were sold at a loss. Here, the IRS will effectively net the 2 years together so that the character of any of the Section 1231 gain will be treated not as a preferential item taxed at preferential rates, but actually as an ordinary income item taxed at ordinary tax rates. This essentially becomes a reclassification exercise. So if there was a Section 1231 loss in the previous 5 years, the current year net 1231 gain will be offset by the 1231 losses that were deducted in the previous 5 years as ordinary losses. So the amount of current year 1231 gain that is offset by prior year's 1231 losses is treated as ordinary income instead of receiving long-term capital gains treatment. Now, to the extent you have a current year net Section 1231 gain that survives this look-back rule, that is, the current year Section 1231 gain is larger than any Section 1231 loss in the last 5 years, or if this rule doesn't apply because the taxpayer didn't have any Section 1231 losses in the past 5 years, then the net Section 1231 gain in the current year will be given long-term capital gains treatment and taxed at 0, 15, or 20%. That is, in order to get the preferential tax rates on the Section 1231 gain, the net Section 1231 gain must be larger than any Section 1231 losses you incurred in the last 5 years. If it's not, again, that gain is actually reclassified and then taxed at ordinary rates. But if it's larger, then you retain the preferential tax rates that would normally apply. So why does the IRS do this? Well, again, taxpayers might want to group all the losses in one year to get the ordinary deduction that year, then group all the gains in the next year to get preferential tax rates in the next year. And so they'll play this timing game. However, if the taxpayer had sold all the loss and gain property in the same year, they would have offset each other because they'd be in the same category. That is, they'd be Section 1231 assets. And so how that net Section 1231 gain or loss would be taxed would be simply whether the net Section 1231 amount would be a gain or loss. If it's a net gain, it would be taxed at preferential rates, and if it's a net loss, it'd be deductible against ordinary income. So this look-back loss rule effectively nets these gains and losses across years in order to specify the correct character of the current year's net Section 1231 gain.